Greetings everyone, welcome to my channel. Candlestick Patterns, a complete guide for successful trading. Candlestick patterns are visual representations of price movements in the financial markets. They provide crucial information about market sentiment and help traders make informed decisions. Candlestick patterns, a widely used technical analysis tool in the financial markets, provide valuable insights into the price movement and potential trend reversal points. Gain a comprehensive understanding of candlestick patterns and how they can be leveraged to achieve successful trading results. This video will cover all the important aspects, from basic doji, hammer, and shooting star formations to more advanced engulfing, evening or morning star, and Harami patterns. By examining the shape, color, and position of the candles, you will gain valuable insights about market sentiment and potential price direction. Learn how to combine candlestick analysis with other technical indicators for stronger trade decisions, as well as the importance of pattern confirmation in achieving success in trading. Unlock the power of visual analysis and stay ahead of the market with this essential knowledge. Disclaimer: the content on this YouTube about candlestick patterns is meant for educational purposes only. It is not financial or investment advice. The videos express the opinions of the creators and not YouTube. Use caution, do your own research, and consult professionals before making any investment decisions. Trading and investing involves risks. Only invest what you can afford to lose. We are not liable for any loss or damage, including, without limitation, any loss of profit that may arise directly or indirectly from the use of or reliance on the information provided. A Japanese candlestick consists of four main elements. Opening price. Highest point reached by the asset's price. Lowest point reached by the asset's price. Closing price of the candle. The candlestick's shadows show the day's high and low and how they compare to the open and close. A candlestick's shape varies based on the relationship between the day's high, low, opening, and closing prices. Candlesticks reflect the impact of investor sentiment on security prices and are used by technical analysts to determine when to enter and exit trades. Long white/green candlesticks indicate there is strong buying pressure. This typically indicates price is bullish. However, they should be looked at in the context of the market structure as opposed to individually. For example, a long white candle is likely to have more significance if it forms at a major price support level. Long black/red candlesticks indicate there is significant selling pressure. This suggests the price is bearish. All of these patterns generate a sign or message only, and you should consult other technical indicators before you engage in a trade. Dark cloud cover reversal. A dark cloud pattern encountered after an uptrend is a reversal signal, warning of rainy days ahead. The close of the current bar must be below the halfway down the body of previous bar. Investors should consider several factors when trading with the dark cloud cover pattern. Look for an uptrend, as the dark cloud cover pattern is a bearish reversal pattern. Pay attention to the length of the candlesticks when making a trade. Note the gap between the bullish and bearish candlesticks for insight into the trend reversal force. The bearish candlestick should close at more than the midpoint of the preceding bullish candlestick. Ensure that both the bullish and bearish candlesticks have larger bodies when trading. If the volume is high during the formation of this candle, there are more chances of the reversal to take place. Also, don't forget to confirm the signals given by this pattern with other technical indicators. Doji Star. The doji candlestick occurs when the open and closing price are equal. The Doji Star candlestick pattern is a significant reversal pattern that can occur at the end of an uptrend or downtrend. It is formed by a combination of two candlesticks, a doji candlestick and a small candlestick. A doji candlestick is characterized by having a tiny body with a very short or non-existent real body. It signifies indecision in the market, where the opening and closing prices are very close together. The upper and lower wicks can be of varying lengths, indicating that there was volatility during the trading session. The small candlestick that follows the doji is equally important in the Doji Star pattern. It could be either a bullish or bearish candlestick, indicating a potential continuation or reversal of the existing trend. Wait for the confirmation of the trend by a close below the halfway of the previous bar. In an uptrend, the Doji Star pattern often suggests a possible trend reversal. The doji acts as a warning sign of market indecision, followed by the small bearish candlestick which indicates selling pressure. This shift in sentiment may consequently lead to a downtrend. In a downtrend, the Doji Star pattern can indicate a potential trend reversal too. The doji, again representing uncertainty, followed by a small bullish candlestick, can suggest buying pressure emerging in the market. This change in sentiment may result in an uptrend. The significance of the Doji Star pattern is amplified when it occurs near support or resistance levels, trend lines, or at key Fibonacci retracement levels. These additional technical factors lend further weight to the potential reversal indicated by the pattern. Traders often use additional confirmation signals or technical indicators to validate the potential reversal suggested by the Doji Star pattern. For example, they may look for bearish/bullish confirmation through subsequent candlestick patterns or utilize oscillators like the Relative Strength Index, RSI, or Moving Average Convergence Divergence, MACD. Engulfing patterns are the simplest reversal signals, where the body of the second candlestick engulfs the first. They often follow or complete doji, hammer, or gravestone patterns and signal reversal in the short-term trend. The bullish engulfing. The bullish engulfing pattern that appears in a downtrend is a clear indication that the market sentiment is shifting to the upside. This pattern starts with a relatively small candlestick followed by a much larger candlestick that closes higher than the previous one. This is a sign that the downtrend is weakening, suggesting a potential reversal is imminent. The bearish engulfing. The bearish engulfing pattern is the exact opposite of the bullish engulfing pattern and indicates a reversal in the market sentiment. It appears in an uptrend and signifies that the trend has weakened. The first candlestick appears to be bullish but will have a relatively small real body in comparison to the other candlesticks that preceded it in the trend. This is followed by a second candlestick which closes lower than the first, showing that the sentiment has shifted towards the downside. This is a clear sign that a downtrend is likely to follow. The evening star. The evening star consists of 3 candlesticks, with the middle being a small star that gaps away from the first candlestick. The first candlestick must be light in color and have a relatively large real body. The star is a candlestick with a short real body that does not touch the real body of the preceding candlestick and is preceded by a relatively large candlestick. The star is followed by the third candlestick, which must be dark in color and must close well into or below the real body of the first candlestick. When the star in the pattern is a doji, it is called the evening Doji Star pattern, and when the star gaps away from both the first and the last candlesticks, it is called the abandoned baby bottom pattern. A bearish downtrend can now be anticipated as any bulls that bought on the first candlestick in the pattern will be under pressure to close out their positions by becoming sellers, adding to the bearish reversal pressure. The morning star. The morning star pattern consists of 3 candlesticks. The first has a relatively large real body and moves in the direction of the downtrend. The second has a very short real body that gaps away from the real body of the first candlestick, and the third is a bullish, light-colored candlestick that closes well into the body of the first or above it. When the star in the pattern is a doji, it is called the morning Doji Star pattern, and when the star gaps away from both the first and the last candlesticks in the formation, it is called the abandoned baby top pattern. A bullish uptrend can be anticipated as any bears who open short positions on the first will be under pressure to cover their short positions by buying the market. Traders can enter a long position if the next day a bullish candle is formed and can place a stop loss at the low of the second candle. The falling 3 method. The falling 3 methods is a bearish 5-candle continuation pattern which signals an interruption, but not a reversal, of the ongoing downtrend. The candlestick pattern is made of two long candlestick charts in the direction of the trend the downtrend at the beginning and end, with three shorter countertrend candlesticks in the middle. The following three methods pattern appears during a strong decline in the market where the bears are still firmly in control as the first candlestick in the pattern is formed. The length of the first candlestick reflects the ongoing strength of the bears. However, the appearance of the second candlestick in the pattern suggests that there may be some weakness in the downtrend as the second candlestick is a small bearish candlestick. This may create some doubt among the bears and may result in some of them taking profit during the next few trading sessions. After a few sessions, the bears may realize that the bulls are weak as they are struggling to drive the price higher. This may encourage fresh bearishness that results in a resumption of the downtrend. The current candle closes at a new low. The candlestick pattern is important as it shows traders that the bulls still do not have enough power to reverse the trend. The Rising 3 Method. The Rising 3 Methods is a bullish, 5-candle continuation pattern which signals an interruption, but not a reversal, of the ongoing uptrend. The Rising 3 Methods pattern appears during a strong uptrend where the bulls have been firmly in control of the market for a while. This control continues during the formation of the first large, bullish candlestick in the pattern. The appearance of the second candlestick. A small bearish candlestick suggests that there may be some weakness in the uptrend. This may create some doubt among the bulls and may result in some of them taking profit on the next few candlesticks. After a few sessions, the bulls may realize that the bears are weak as they were unable to make a new low. This may encourage fresh bullishness that results in a resumption of the uptrend. The final white line forms a new closing high. The pattern is definitely bullish. Candlestick reversal, hammer or gravestone. The hammer candlestick. The hammer is not as strong as the dragonfly candlestick, but also signals reversal after a downtrend. Control has shifted from sellers to buyers. The shadow of the candlestick should be at least twice the height of the body. The hammer candlestick is a bullish trading pattern that may indicate that a stock has reached its bottom and is positioned for trend reversal. Specifically, it indicates that sellers entered the market, pushing the price down, but were later outnumbered by buyers who drove the asset price up. Importantly, the upside price reversal must be confirmed, which means that the next candle must close above the hammer's previous closing price. A gravestone candlestick. A gravestone is identified by open and close near the bottom of the trading range. The candlestick is the converse of a hammer and signals reversal when it occurs after an uptrend. It looks like an inverted T with a long upper shadow. It is a bearish trend that indicates a reversal is on the horizon. Traders can assume that the reversal will be accompanied by a downtrend in the security's price. When a trader identifies a gravestone doji, they may be able to profit on a bullish position or by taking a position on a bearish trade. Hanging Man. The hanging man pattern is a single candle formation found at the top of an uptrend. More controversial is the hanging man formation. A hammer candlestick is a bullish signal in a downtrend but is called a hanging man when it occurs in an uptrend and is traditionally considered a bearish reversal signal. It is advisable to treat the hanging man as a consolidation pattern, signaling indecision, and only take moves from subsequent breakouts below the recent low or high. Alternatively, the hanging man pattern could be used to close an existing long position rather than entering a new short position. This pattern is popular amongst traders as it is considered a reliable tool for predicting changes in the trend direction. A hanging man is considered a bearish candlestick pattern that issues a warning that the market may reverse soon as the bulls appear to be losing momentum. The bearish hanging man pattern becomes slightly more reliable when the underlying security is making an all-time high, or when the hanging man appears in an extended rally that has become significantly overbought. Harami. A 2-day pattern that has a small body day completely contained within the range of the previous body, and is the opposite color. Harami cross. A 2-day pattern similar to the Harami. The difference is that the last day is a doji. Due to the lack of a real body after a strong move tells that the previous trend is coming to an end and a reversal may take place. The high or low of a Harami cross setup provides resistance or support for any further price moves. The pattern can be a bullish Harami pattern if it appears at the end of a downtrend, or it can be a bearish Harami pattern if it appears at the top of an uptrend. As a trading strategy, we will combine the Harami with Bollinger Bands. One should only trade the Haramis, which form when the price touches a level of the upper or lower Bollinger Bands. For example, once the price touches the upper Bollinger Band at the same time a Harami is formed, you can enter a short position as shown below. One should hold their position and close it until the price touches the lower Bollinger Band. Marubozu. Marubozu are even stronger bull or bear signals than long lines as they show that buyers/sellers have remained in control from the open to the close. There are no intraday retracements. The Marubozu candlestick is a type of candlestick pattern that represents strong market momentum in a particular direction. Bullish Marubozu. A bullish Marubozu is characterized by a long green or white body with little to no upper or lower shadow. It indicates that buying pressure was dominant throughout the entire trading session, and the price closed at or near the high of the period. This suggests strong bullish momentum. Bearish Marubozu. A bearish Marubozu is characterized by a long red or black body with little to no upper or lower shadow. It indicates that selling pressure was dominant throughout the entire trading session, and the price closed at or near the low of the period. This suggests strong bearish momentum. Traders often interpret Marubozu candlesticks as signals of significant market strength in the direction of the candle. They can provide clear indications of strong buying or selling pressure and may be used to confirm or support other technical analysis tools or patterns. The piercing line. The piercing line is the opposite of the dark cloud pattern and is a reversal signal if it appears after a downtrend. Certainly. The piercing candlestick pattern is a two-candle reversal pattern that often signals a potential bullish reversal in a downtrend. It is also known as the piercing line pattern. This pattern provides a visual representation of a potential shift in market sentiment. Here's how the piercing candlestick pattern works. Downtrend. The piercing pattern typically occurs during a downtrend. The first candle is a bearish, red or black, candle that continues the prevailing downtrend. Second candle. The second candle is a bullish, green or white, candle that opens below the low of the previous candle, but closes at least halfway above the body of the previous candle. This bullish candle pierces through the body of the first candle. The close of the second candle must be above the halfway of the previous candle. It's important to note that the piercing pattern is considered more reliable and significant if it occurs after a sustained downtrend and near support levels or key technical levels. Traders often look for additional confirmation signals, such as higher trading volume, other bullish reversal patterns, or the convergence of other technical indicators. Shooting star. With a shooting star, the body on the second candlestick must be near the low, at the bottom end of the trading range, and the upper shadow must be taller. This is also a weaker reversal signal than the morning or evening star. The shooting star candlestick is a type of candlestick pattern that often appears at the end of an uptrend in a financial market. It is viewed as a bearish reversal signal and can indicate a potential trend reversal from bullish to bearish. The shooting star candlestick consists of one candle with a small body and a long upper shadow, wick, that is at least twice the length of the body. The lower shadow, if present, is usually very small or non-existent. The candlestick resembles a small candle with a long tail pointing upward, which gives it the appearance of a shooting star. The formation of a shooting star suggests that buyers pushed the price higher during the trading session, but eventually, sellers took control and pushed the price back down. This indicates a strong selling pressure and a potential reversal in the market direction. The pattern requires confirmation from the next candlestick closing below halfway on the body of the first. Traders and analysts pay attention to the shooting star pattern to make trading decisions. It is often seen as a signal to sell or take profits on existing long positions. The presence of other technical indicators or chart patterns can help confirm the validity of the shooting star pattern. Remember, these are just a few examples of the various candlestick patterns that exist. To become a successful trader, it's essential to familiarize yourself with as many patterns as possible. Thank you for watching this video. We hope you found it informative and useful. Don't forget to subscribe to our channel for more helpful content. Happy trading!